Welcome to the Money to the Masses podcast, putting you in control of your finances. One is an expert with years of experience giving free advice. The other owns his own microphone and can do the odd bit of editing. Here are your hosts, Damien Fay and Andy Leaks.
Now, Damien, before we get on with this week's podcast, you had something quickly to say about our sponsors.
Yeah, we've got a new sponsor, Money Farm, and Money Farm are an online investment advisor and one of the biggest digital wealth management companies in Europe. So a big thank you to them for sponsoring the podcast. Now, Money Farm create portfolios to maximise long-term returns using ETFs to make incredibly cheap portfolios. And you even get the first £10,000 of your portfolio invested without any charge from Money Farm. And if you enter the code MTTM20K into the box when you sign up, you get the first £20,000 of your portfolio invested and run by moneyfarm.com without any charge.
Great stuff. On with this week's show. Hello and welcome to episode 93 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leaks. Damien, welcome to a sombre, Europe-less Britain. How are you doing?
Do you know what, Andy? I'm having a good week. I'm hugely upbeat about this week, and it's not because we've exited the European Union, because I don't want to. I like to keep politics out of the show, but I wasn't in favour of it, just to make that clear, because what I'm going to do in this podcast is actually talk about the Brexit and what it means for us, but it's really also to put a positive slant on things, and actually we're not going to be all doom and gloom, and I've had a good week, ironically because of Brexit, so but I've had an incredibly busy week. I'm not going to be too downbeat about the whole thing. We've been knocked out of Euros as well, so that was to be expected.
Yeah, the England players are having an absolute ball. They can go on their holidays a couple of weeks early, so I'm sure they're absolutely delighted with that.
Harry Kane was looking tired, and I do think Harry Kane probably had one eye on a villa in Barbados or something, because the poor man was looking tired.
He was. The telling sign was he actually took to the game in flip-flops. That's how sort of in holiday mode he was. The way he took a free kick at one point.
That's what I was about to say. The way he was taking free kicks, he would have probably done a better job with flip-flops or clown shoes on, because they were wayward, to say the least.
He was definitely trying to... Anyway, this isn't a football podcast, but he was definitely trying to do a kind of a Ronaldo type thing where he's taking a slightly different stance and trying to hit the ball through... Oh, it was awful. It just...
And like you say, this isn't a football podcast, but people may know that I have a season ticket at Tottenham. And so I watch Harry Kane, and I've seen Harry Kane come from nowhere to be this great striker. And trust me, Harry Kane does not take free kicks for Tottenham. He has scored one free kick for Tottenham, and it was a deflection off the wall. He just does it. He doesn't take corners, and I don't know what Roy was watching and deciding that Harry was the best striker of the ball in the team. Anyway, it isn't about that in this podcast, but he needs to go to White Hart Lane a bit more, Roy. Well, he's probably got more time to do so now.
Yeah. Absolutely. Right, okay, yeah, it isn't a football podcast, as we keep mentioning, so it is a money podcast. We're going to be talking about the Brexit in the main today. Damien, you're going to put a positive spin on it, which I really need to pick up this week. So I don't know really what we're going to talk about. Is this just a conversational type thing? We're going to be answering questions.
There are questions. We've got all of that, Andy. What you just said, we've got all of that and more. I mean, there's going to be a bit of... I'm not going to put a positive spin on. Perhaps I was misleading slightly, but I'm not going to be as downbeat. I'm going to ignore the social negatives that have been going on out there in terms of sort of the racism and things, which obviously we all absolutely despise. I'm going to just focus on things to do with the economy, jobs, and how it impacts people's finances, which is what everybody wants to know, because Boris and everybody else on that side of the campaign can't tell you. Neither can people like David Cameron tell you what's going to happen. So what we're going to do is going to focus on that. We're going to talk around one or two questions we've had, if we have time, and about investing as well, because there's been some interesting developments in investment markets and how you make money in investment markets, or more importantly, how 80/20 investors made a lot of money in the last week. So despite the 2 trillion or whatever it was, 20 trillion, $2 trillion that got wiped off stock markets, not everybody was licking their wounds. But it was interesting this week because it's been quite busy for me, as you can expect. Funnily enough, on the Sunday immediately after the Brexit vote came in, I was surprised as anyone that the Brexit vote happened. But then that's probably because I live in London, and I actually got asked by ITV to go and do some vox popping as I did before. Do you remember I went to York? I was asked to go to Birmingham to do it for them on the Sunday at incredibly short notice, and I actually turned it down because I had other things planned. But there's such is the appetite for people wanting to know what's going to happen that they wanted me on, and it was a negative for me actually. But the Brexit, I wasn't going to mention it. Well, I almost mentioned it next week to announce that I was going to be on Radio 4 talking about DIY investing. I was meant to be on Moneybox on Wednesday, and that got cancelled because Farage and his cronies
Postponed, hopefully.
Well, it is. Technically, I've been told it's postponed, but we'll see because it depends on the appetite for DIY investing. Which, if markets tank and fall, then they may.
You could argue that now's the best time. Now's the best time to have some different sort of input into how people can make money in a tougher market.
Well, do you know what, Andy? We're going to touch upon that. Right. So let's start off by talking about investing. So we've all seen, or after the referendum result, the market absolutely tanked, and there were $2 trillion wiped off markets globally within the first 2 days. Yeah. And that was, for a lot of people, a massive shock. And the reason that occurred was because in the week prior to the referendum, about a week before, markets were still thinking we would be leaving the European Union. So they'd been protecting themselves against the possibility. They actually thought there was an outside chance we could go. They didn't necessarily believe we would leave the European Union, but they thought there was an outside chance. So big investors, big corporate investors and whatever pension funds, etc., they all were taking out protection just in case we left the European Union. Then what happened in the week sort of leading up, in the days heading towards the referendum, was there was a distinct belief that suddenly we weren't going to leave, and the polls were coming out to suggest that we were going to actually remain in the European Union. Now, the greed is a wonderful emotion, and what happened in those few days is that assets started rallying. So you saw the FTSE 100 started picking up, all the equity markets started rallying, and of course people didn't want to miss out. So what they did, they took off all that protection against the possibility of us leaving the European Union and started piling in on the basis that we would actually remain. Of course, the reason they actually, I've heard subsequently, and it was a great bit of analysis by a guy who is into market research. A lot of the polls that started to suggest that we would remain were actually based on telephone polls, and all the telephone surveys suggested, generally, it's just the way they work, that we would remain. It was on the online polls that suggested people would leave, but in the lead up to the referendum, there were more telephone polls that were being produced and published, so that was why there was a slight skew to remain. Of course, people started backing that with their money. Then when it went wrong, or if you're a leave advocate, it went right for you, but when we actually decided, the vote came in and we left, then the markets immediately had to try and reprice everything.
Yeah.
And things plummeted. And one of the biggest impacts we had was the value of the pound just dropped. I mean, it dropped by the biggest amount it had done ever in a single day. And then in the subsequent day, it then fell a bit more, and we were at a 30-year low. So we had falling equity markets, but we also had, combined with that, the pound was completely tanking, and it still is now as we record this podcast. It's recovered a bit.
Interestingly, the pound started to drop after the first four results came in. I think there's over 300 results. I sat up through the night until 4 a.m. and the market analysis and the forecasters in the studio was saying the pound has dropped by 5% in the last 5 minutes, and that was after just four. I think two of the main ones were like Newcastle and Sunderland, and it was incredible to watch. I must admit, I had a weird sort of feeling of nervousness but excitement. You know, that almost like a car crash type thing where you don't want to look, but you sort of do end up looking. Do you know what I mean? It was
I totally
crazy
get what you
situation.
mean. Because, Andy, there was always a sadistic part of me that wanted to see what would happen beyond if we did decide to leave. And
unfortunately, I think that's why the vote went that way, because I think there were a lot of sadistic people. I mean, this isn't a political thing, so this is just my views. I do think a lot of people voted leave, kind of thinking it wouldn't happen, but just to see what would if they did, and they kind of got their way, you know. I don't know.
Yeah, but as you say, what was fascinating is to see that impact. I didn't see those early votes. I didn't sit up and to watch it, and the part of me wished I had. And the fall in the pound was incredible, and the reason, obviously, that was because the implications for our economy could be significant, and there's a talk of us possibly going into a recession. Just one thing on that recession point. People always talk about we're going to go into a recession. We technically won't know if we've gone into a recession till the back end of next year, because a recession is where you have 2 consecutive quarters of negative growth. And so if you think about it, that's going to take at least 6 months to unravel from the point where they actually publicise the data. So when we find out, it'll probably be at the earliest at the end of this year, by which point we probably already were in recession anyway. And do you know what I mean? It's always a backward-looking thing. So when you do get to that point and they start shouting we're in recession, we were probably already in recession anyway, long before. But
yeah,
we'll see if that actually comes to fruition. But the fall in the pound has had a massive impact on. Well, that will probably be one of the biggest things that have an impact on everybody. So I'm going to just run through some of the things that I've been asked about, because I've been asked by some of the papers what's going to happen, what can I think, what can we expect the outcome to be, and how will it impact our finances. So let me just run through. I don't know, okay, the absolute answer to all these things, but I can just speculate as possible outcomes. So that's what I'm going to do here. I'm not going to promise you that I know the answers. It's just that we can speculate, we can chat around it.
Yeah, good.
Okay, so if we just start with jobs. Now, the job market could struggle slightly, because the biggest thing that, one of the benefits of the European Union was the idea that a company, particularly multinationals, could be placed in this country and have their headquarters or offices here and still sell services across the European Union. Largely because of something known as passporting, particularly in the financial services, which means they can have a standardised set of compliances and business rules effectively across the whole of the European Union. So that was a real positive. Now, the fact that when we actually leave, because don't forget, we haven't actually left yet. This is all just, we haven't pressed the button, and it's unlikely, because of what David Cameron said, it's going to be about 2 years and 3 months before we actually do leave. But when we do leave, then companies are going to be thinking, well, we still need to be based in the European Union, be able to do business. So they might start moving their headquarters over there, which will mean job losses over here. Now, that's already seen signs of occurring, and I think a lot of it is obviously companies trying to work out what the impact will be and speculating about what they might do. The positive for people, I have to say, is that a lot of people, and most employers in this country are actually small and mid-sized companies. Most people, believe it or not, don't work for multinational companies. So in that respect, there is a slight insulation from that sort of scenario. For most people, their employer isn't about to up sticks and leave, so they won't have necessarily immediate redundancy. But of course, if their business has any exposure to exporting, then that could be a problem. There might be issues there. And also if you import anything, because your costs will increase. And let's be honest, there'll be a lot of businesses on Friday morning that woke up and found their costs had increased 10% if they were importing stuff because of that exchange rate differential.
Yeah.
Now, there's not a lot you can do about this. I mean, you can't protect yourself. You can't double guess what's going to go on. But, I mean, one of the things, if you're somebody and you're in a secure job, you'd be probably well advised to keep your head down and carry on until the dust settles, and particularly if you've been there a long time, because if you've got any redundancy potential built up, then if something does happen, you don't want to lose that by sort of jumping ship. So I don't think we're going to find out what's going to happen in the jobs market for quite some time. But I mean, I'm already here anecdotally about employers not or shelving their sort of recruitment drives for periods of time until they can actually work out what the impact is going to be on them. And even I've heard about people who've had job offers withdrawn where they were going to run new divisions of parts of companies, in particular in the finance industry, because as a result of the referendum, don't forget that banking shares, particularly certain banks, fell by 20-30% in a single day, and actually they were suspended in trading. And of course, if you're a business and you've lost almost a third of your value overnight, then you can see why they're trying to just consolidate things and trying to weather the storm slightly. So we don't know what's going to happen with jobs, but you can almost be certain if a recession does come, it's not going to be good news for employment. How will it affect house prices? Now this is interesting because in the lead up to the referendum, there was a lot said about house prices would plummet, and I think lots of it was down to the emotional pull of house prices. Everybody talks about, oh, my house has gone up by X amount, or do you know what I mean? There's always this kind of sense of how much your house is worth. There's a sign of your wealth and prosperity, because people feel good if their house prices go up, even though materially they're not actually better off, because if your house goes up in value, you're still living in it, and unless you somehow remortgage or take equity out, you're not going to probably be materially better off from one day to the next. But it's that feel-good factor that people like. And I think they just like... It's dinner party talk, isn't it, Andy?
Yeah, but it's also relative as well. If your house price goes up by 5%, so is the house down the road that you might want to move into. So you're not really any richer. It's just, like you say, makes you feel a lot better about yourself.
Yeah, and the general feeling that out there was that house prices would fall if we left the European Union. And part of that is because the possibility of recessions and the drying up of credit lines would make it harder for people to basically get a mortgage. And it would also dry up demand, and there'd be less capital out there being pushed into property, so prices would start to fall. Now, I know for certain, because I've spoken to some of them, there were young people who want to get on the property ladder, who said to me, I voted for leave because I want to be able to get on the property ladder. Now, that's their prerogative, and that's their decision. That's the wonderful thing about democracy, that people can vote for these things. But I do feel slightly that argument was oversimplified, because people will obviously latch onto it. One of the arguments that is being made is that house prices will fall, particularly in London, because the wealthy investors, we're talking the top end, the Mayfairs and all that sort of the world. Now, the top foreign investors would come in and buy up large chunks of residential property in very exclusive and expensive areas, and there's a kind of trickle-down effect into the house prices, particularly in London, and then slightly into the areas surrounding. And there's a big divide between London and the rest of the country. Of course, with us leaving the European Union, then foreign investors would be reticent about committing large sums, because they just don't know what is going to happen. So they were saying there were going to be flights of capital, maybe people pulling their money out. But there is a flip side to this, because the pound has fallen 10%, it's picked up a bit since then, so whenever you listen to the podcast, the 10% figure might not be absolutely nailed on. The forecasts are that if things keep bumbling along, the pound could fall even further, as much as another 10%. If you're a foreign investor, suddenly house prices in England or the UK have overnight become 10% cheaper. Because if you're somebody, let's just say you're holding dollars, then your dollars buy 10% more of anything priced in sterling. So there is going to be an impact from that. I mean, that's an attractive proposition. So I'm not convinced that the housing market will completely collapse overnight, but only time will tell. I mean, anecdotally, estate agents aren't telling me that they're seeing a complete drying up of inquiries. In the recent months, there'd been a drying up. We talked about it on a previous podcast, and there seemed to be signs that the housing market might be slowing, but that hasn't amplified in any way since the Brexit. I mean, it's only days. We've got to let this play out. All we know is that we voted for Brexit. I mean, when I say Brexit, we've not actually had one, but we've voted for one, and so we've got to see what happens. And there's a lot of people who, like I say, are thinking they're going to snap up a bargain and buy a house. Unfortunately, in an environment where house prices will fall, it could be reflective of the economy being weak. If the economy is weak, then the chances are that jobs will be under pressure, wages will be under pressure, and also you may struggle to get credit. So the ability to buy a house, even if it starts to reduce in price, will also fall. So it's not going to be simple that now we've opted to leave the European Union, that everybody's going to be able to fill their boots with property at cheap prices. I just don't think doesn't appear to be happening at the moment. So going forward, we might see some sort of stability of house prices, but I'm not sure people can link it directly to the European Union.
Okay, good. What next?
Linking onto that is interest rates. Now, people's ears might prick up on this one because this has a more direct impact on most people's lives. Now, when we've talked about interest rates in the past, we don't do it regularly because we don't want to date the podcast, but in a nutshell, the date at which interest rates are going to go back up, or the first rate rise, has been just disappearing into the distance for as long as almost I've been doing Money to the Masses. It just seems to be that we almost get there, and just as we're about to do it, something goes wrong, or we ease off and the date goes further forward. Before the referendum, markets were pricing in that the first rate rise probably wouldn't happen to the back end of 2018, possibly 2019. Now, since the referendum, markets are pricing in a 50% chance that interest rates will be cut next month.
Cut. Wow.
Cut. So we're looking at a cut from 0.5%. That's like having a slither of a birthday cake and deciding you're going to share that up when there's just nothing there to almost share. Sort of take another slice of it, and that may or may not happen. But the reasoning behind it is because, do you remember when the economy starts to slow down, one way to try and boost spending is to lower interest rates? Because if you lower interest rates, the idea is credit becomes cheaper, consumers feel more wealthy, anybody with savings are more inclined to go out and spend and buy assets because their savings aren't getting anything in the bank. Similar thing can be applied to, the logic can be applied to businesses, and it's meant to boost the economy, and that's what has happened in recent years. The problem is that while people might punch the air, the 60% of people who've got mortgages that are on their companies, their lenders' variable rates, so they sort of can go up and down largely in line with the Bank of England's base rate, they may be punching the air and thinking, God, my mortgage might get a bit cheaper. I mean, it's not going to get that much cheaper, but it might get a bit cheaper if they do cut rates. But there was one thing, it's a bit like standing on the Titanic, okay? When we hit the iceberg in the sort of back in the financial crisis, all the lifeboats were sort of, loads of them went out into the sea to sort of try and rescue everything, and that was us putting interest rates back to like all-time lows. Now, we were obviously trying to normalise things and put interest rates back from 0.5%, eventually try and get back towards like long-term averages of say 5%. Well, that's equivalent of sort of getting your lifeboats back. So it's a bit like us seeing when interest rates get cut to even further from 0.5%, sort of punch in the air as we see the last lifeboat be sort of cast off, and then we suddenly realise that we're all stood on this sinking ship, which is the economy, and this cruise liner is only going one way and we are stuck on it. So it's not the perfect analogy, but it's just pointing out that...
No, I'd have preferred to hear about... I'd have preferred the odd mention of Kate Winslet and Leonardo DiCaprio, but it was good.
It was good, but not perfect, I suppose, is your point, Andy. But what it just highlights is if we are doing that, if we're whacking the panic button again and again and it just isn't working anymore, then could be a real problem. And so you might enjoy low interest rates for a sort of a period of time, or lower mortgage rates, but it could be more indicative that people might start struggling to actually pay their mortgages. Now, there is a fly in the ointment of that. Good news for some consumers is that not everybody who is on a standard variable rate mortgage has their rate directly tied to the Bank of England's base rate. So what that means is there are a lot of mortgages that say, for example, your interest rate that you pay on your mortgage has to be 2% above the Bank of England base rate. Of course, if the Bank of England cuts rates, your mortgage rate will go down. But a lot of people, their mortgage rates are not tied to the Bank of England base rate. They actually are set at the discretion of the lender. And after the financial crisis, when the interest rates were cut, mortgage companies got caught out by this small print that actually was meant to be put in so when interest rates went up, they could keep charging you more. But they never factored in the fact that interest rates would ever go down so low, and therefore they become they're actually costing them money effectively. So what it means for people who are on those standard variable rates that aren't directly tied, interest rates may go down, but given that banks and mortgage lenders are going to be under intense pressure going forwards, especially if interest rates get cut low, because don't forget banks will make less money on their investments and therefore their businesses will be less profitable. They're probably not going to pass on any rate cuts. So even if they go down, you're probably not going to get a cheaper mortgage anyway. So I might have just ruined somebody's day there, but that's just the truth of the matter. So ironically, just to finish off interest rates, in the far distant future, we don't know when, because the pound plummeted so much, okay, if that becomes sustained over time, then the cost of things that we import, and don't forget, Britain has to import a lot of things, and the food, petrol, and all sorts of stuff that we import. And don't forget that it's not just about the cost of things like cars that we import. When things are made in the UK, they can be made here, but the parts that they might be used in building that, or might come from abroad. So the costs for those businesses might go up. And now those costs, they're not going to absorb them. They're going to pass them directly onto the consumers, and prices go up. Now, if we get that, we could get a sustained period of inflation, so an inflation shock. So prices start going up. Now, if that happens, that's not going to be a good thing, especially if it's not matched by wage growth. And so you could get to a period where the Bank of England might have to start increasing interest rates, because increasing interest rates, just very simply, tends to bring inflation back under control. Just think of it if you're driving your car along the road. When you change up the gears, the engine revs drop down every time you change up the gear, and that's basically what the inflation does. So it stops the economy overheating. That might not happen over sort of any time soon, and the Bank of England certainly won't want to increase rates while everything's so fragile. But I'm just giving people the sort of roadmap where we could go. I don't know which is going to happen, but it just being upfront and honest, these are the possibilities that we could have. So interest rates could go down, but they could go back up. I've touched upon bills and the cost of living in that last piece about interest rates. They could go up because the cost of things we import, or the things that are made from things that are imported, could go up. And probably one of the most obvious things that are going to be impacted is the cost of holidaying. Now, just to put this into context, if you had gone and bought $1,000 of currency before the referendum, the day before, it would have cost you £667 to buy that, okay? Now, immediately, the day after, because of how far the pound fell, that same $1,000 would have cost you £760.
Wow.
Which, that's £100 difference. That's an enormous amount. So that's what we're looking at. If the pound recovers, that difference will be obviously closed up. But it's not recovering at the same rate which markets have bounced. I mean, there's a lot more pain to come, I think.
Is that relative to all currencies? I don't quite understand how it works. So you were using the dollar as a good analogy there. What about to the euro? What about to other currencies around the world?
Do you know what, Andy? This will make people probably chuckle. Sometimes you have to just laugh at these things. Pretty much, at the point that the referendum happened and the vote came out, the pound fell against, I think, every currency in the world, including the currency of Zimbabwe. And that just shows you how dire things were getting at that point. So the pound, everything's become more expensive because of that. And that's what the problem is. And if you go on holiday and you book, say, accommodation, hotels, villas or whatever, in a foreign currency, when it comes to paying, that conversion rate is going to bite, and that's going to cost you more. So there's not much you can do about it now. You're going to have to just shop around and try and get the best rate, or just pray that things balance themselves out and the currency starts to recover.
I mean, you can't go back in time, but you could have heeded your advice from our podcast a few weeks ago, where you invited listeners to insure their holiday money against a Brexit, and that was a really good piece. I wish in a way I would have heeded that advice, because of course I'm going away in 3 days' time to Europe. And I remember having
I don't know why I'm laughing, Andy, but I think it's because you're laughing.
I know. I remember having a chat with one of the dads in the playground on Thursday, and I said to him, I think I might buy my holiday money today just in case. And we both came up with the surefire thing that no, we're not going to exit. It will be fine. It'll all be fine. So yeah. Oh well, never mind.
But your conversation there with was that a dad in the playground? Did you say, Andy?
It was, yeah.
Yeah. That people I think politicians don't realise appreciated the impact it would have on people in daily lives. Okay, and how nervous people are. And I do share too much, I think, on this podcast, but I do think that's why people like our podcast, Andy. I'm going to tell you this story actually happened to me this week. As people know on this podcast, I suffer from Crohn's disease, okay? So obviously, if you don't know what that is, go look it up. It's good for people to know what it is, but basically, it means I've had problems with my stomach and intestines. So anyway, every now and then, I have to basically go and get a bit of an MOT where they take a look inside. Okay, and we all know how they do that.
Are we talking up or are we talking down?
We're talking up, Andy. And this just shows you the nervousness of people. Do you remember in the past I've talked to people about if you go onto 80/20 Investor page, if you go onto Money to the Masses, and at the top of the page is Join 80/20 Investor. And people can see about what 80/20 Investor, which is my DIY investment service, which is an even more amazing piece on in shortly, Andy. I'll come to that. But people can go on there and they can click. There's a chat button and they can click on chat, and it does when you do that. It will come through to me and you'll chat to me personally, live via sort of the laptop or whatever. I don't know whether I should tell people this, but it also comes through to my phone, okay? So I'm sitting in a hospital ward with a backless gown on, having a conversation with a potential 80/20 investor member about investments. And this is the wonder of modern technology, you see. You can sit there in a backless gown about to go into I suppose it's an operating theatre. And it just shows how bizarre things are. Anyway, I had that conversation, and I got wheeled into the room. And as I got wheeled in by the various different people who work, you got all this sort of. Whenever you go into those rooms, there's about 6 people, isn't there? There's the main guy, surgeon or gastroenterologist, as this guy is, and they're all in their sort of scrubs and things. And as I got wheeled in, I happened to look over it. He was in the corner on the NHS computer watching intently the movements of the pound against, I couldn't make out which currency it was, and he was giving almost a live commentary, and it was the most bizarre situation with me sitting there being told what was about to happen to me by one of his staff, while he was sitting there in the corner, don't worry, I think the pound's stabilising, and all I could think personally is, God, I hope he's concentrating when he does this, because right now the pound is not the thing I'm most worried about. And that just shows you, I don't think I would ever, if people said to me, how worried are people about the pound and how it impact people, that is how worried they are, whereby they should be concentrating on something that's a little bit more important, and they are in a surgical room with their mask and all that sort of stuff on, talking to each other about the pound. But there you go. Anyway, I digress. So therefore, that's what's going to happen to your holiday money. But then we're going to move on to investments. So what's going to happen to shares and the like. Now, as I've just told you, the markets fell. The equity markets fell 11%. The FTSE fell 25% in 2 days. And there was everything was trounced. Everything that was a risk asset fell. Now, there has been a bit of a pullback slightly on the FTSE 100. And at the point we're making this podcast, it had got back to the level it was before. But people are using that as a sign of everything's okay. But what I would say to them, the hardest hit part of the equity market in the UK was the FTSE 250. Now this is just a bit of an FYI tip here, that the mid-sized companies that live in that FTSE 250 index are the ones that are most exposed to the ups and downs of the UK economy. And so they're a good barometer of what people are thinking. Now, despite the fact that the FTSE got back to where it was before the referendum and marginally above, that index is still down 7%. I mean, that was falling at such a rate in the days after. And it's a good indicator because their earnings tend to be derived from within the UK. They largely export less than some of the FTSE 100 companies, because don't forget the FTSE 100 companies, about 80% of their earnings are derived from abroad, they are still struggling. And anybody investing in those will probably be licking their wounds at the moment. The other thing to bear in mind is that there's been a real buoyance from the fall in the pound for the FTSE 100, because there's lots of companies that may have their earnings in foreign currencies, so when you convert it back, it's actually a positive, and for some of the things that they do. So actually, in the recent weeks when the pound has been falling, because even though the sharp fall occurred in the last couple of days, the steady fall has been going on for a while, because people were worried about a possible Brexit vote. Anyway, the reason I'm talking about this is because sometimes in life you have to blow your trumpet, and because people will kick you when you're down. And I've had a whole load of emails from 80/20 investor members, because my portfolio, I remember I invest £50,000 of money live on the website to show people how to use it and what to do and how to sort of navigate markets. In the 2 days after the referendum, when markets were down in some cases double digits, my portfolio was up 5.25%. So that means that since I've been running this from March 2015 till now, June, my portfolio is up over 6.5%. Now, to put that into some kind of context, the average fund manager over that same period of a year and a few months is down 2.14%. Even the legend that is Neil Woodford is down 1.73%, and the FTSE 100 over that period is down 8.93%, and I'm up 6.5%. So I'm going to pat myself on the back just for 5 minutes. Let me have that. But the reason, do you know what I wanted to say? The thing that I like the most about it, I only do that. I mean, I live in a end of terraced house. I don't have a lot of money. I'm just a normal kind of guy. The whole point of the exercise and why I do it is to educate people how to run money, because it's basically what my job is and my expertise is. And I had a number of people email me immediately after saying about how much they couldn't believe the money they'd made when markets were down. And there was even one guy who emailed me and said he made £20,000 on Friday alone. And
wow.
I'm going to tell people how I did it. And so if you're listening to this podcast, you're going to get some value out of this now. Now, 80/20 investor members don't need to worry, because I'm not going to give away enough so people can see exactly what I bought and when and exactly how I did it. But the reason I was able to make so much money, the sort of essence of it, that's fine to share with people who listen to the podcast, because I want to add value. Now, over the last few months, the 80/20 investor algorithm, it started to favour effectively assets that weren't in the UK or Europe, so European equities or UK equities. They started to be sort of reduced exposure to it. So obviously I did the same thing in my portfolio. I started to favour global bonds, so they are in global government debts, so things like treasuries and stuff like that, and also global equity, so American equities. I even had at one point Japan equities, and so basically there was a real global feel to what I did. And also there were some certain funds that are designed to try and smooth out volatility, and I had a decent cash holding as well that I'd increased recently. But again, I'm not going to tell too much more than that, because you need to go look at 80/20 Investor. Take out a free subscription. You can read it all for yourself anyway. You get a free month, by the way. Just add that in there. And by doing that, what happened is when the referendum happened, the theme of the pound had been falling slowly over a period of time that was helping to buoy up anything that was in a foreign currency. But there was also the equities were doing quite well anyway. As soon as the referendum occurred, then my portfolio deliberately benefited from the fact that the pound not only plummeted, so everything that was denominated in a foreign currency, so sterling or anything like that, was immediately worth 8 to 10% more. And also bonds, which I had a large holding in, as well as the equities, the bonds actually rallied, because what people do is they tend to sell equities and they buy bonds, don't they? And so there was a double kicker for any global bond fund. So in an essence, what I'd done is manoeuvred the portfolio to the point where the perfect storm of not only a market fall, but a market fall with a currency fall was the real kicker that helped benefit from that. So even though some of the equity holdings that I had would have fallen slightly or even fairly sharply in the day after, the currency was able to balance that out. Do you see what I mean? So it was actually you still made to make large profits. So there were funds that were up 10% in a day and stuff like that. So that's how the 80/20 investor members were able to make money, because obviously the best of the best selection that we have, the funds, they made money. And interestingly, there wasn't a single stop loss alert, because I send out stop loss alerts for the short list of funds. Not one has been sent out since the referendum. And you would think that in a market that crashed like it did, they would, given that the limit for which we send them out is at 5% fall from their high within a month. So yeah, that's how I was able to do it. Going forward, this is quite interesting. So what do I think is going to happen going forward? I don't know. And this was quite key into the week before. Do you remember I was talking about the week before the referendum, where people were repositioning and taking on risk? Now, obviously, I follow a process, and that's the whole idea of 80/20 Investor, to teach people, just follow process, don't let the emotions get you carried away. It would have been easy to copy all those people, and you would have thought that that would have been the best thing to do, because everybody was saying Remain was a done deal and you need to be piling back into the markets. That would have been easy, but it didn't, because it just stuck to a process. Now, I will still do that going forwards. Whether the portfolio will continue to make money at such a rate is unlikely unless the pound keeps falling. I know there is a chance that will happen, but also equity markets need to pick up as well. So if the pound was to suddenly strengthen overnight because all this Brexit lark was suddenly forgotten about in a distant memory, then those gains would obviously reverse. But that's unlikely, because we're in for a bit of a long haul here, aren't we? We still haven't even invoked Article 50 and all that sort of stuff. So that was how I was able to make so much money in such a short space of time and be up so much. Now, I'm going to probably be making changes in the next week or so to the portfolio, because every month we publish the new best of the best selection. I mean, every week we publish new fund data as well. So there's going to be more research and stuff coming out. So if you haven't tried 80/20 Investor, I'm not just making this stuff up. It has obviously performed brilliantly in this environment. But like I said, I'm just really chuffed and made up for the people who run their own money and have made profits in that time. And of course they can bail out the market and keep those profits if they want. I mean, I always remain in it because I'm just illustrating what we do. So yeah, 80/20 Investor has done well, and it's one of my real things I'm most proud of, I would say, on this market sell-off, because it was a very, when the market, all the headlines were going about billions wiped off the market, then it was quite nice to know that I'd actually made a difference to some people out there.
Brilliant stuff. It must be quite bittersweet, though, in a way. Obviously, great news on making the money and sort of bucking the trend, if you like. But it's bittersweet to kind of be making it on such what is a volatile situation for our country and our island, and also potentially it's almost like backing against your team, isn't it? Watching the pound fall, but actually making money on that happening. It's a weird sort of juxtaposition. It's kind of like betting against your football team in a way, but you prove that it works. It's good.
Well, interestingly, Andy, I had 2 emails that came through that were on slightly opposite sides. I had one, obviously, like you know, I try and be completely neutral about politics. I had one gloating person about the fact that they'd voted Leave, which obviously would cause a bit of annoyance for a lot of people, I suppose, but half the population wouldn't mind. So he would gloat on the fact that he'd left, but also gloating on the fact he'd made so much money. But then equally I had another chap from Scotland who wrote in and said, despite the fact I'm absolutely upset for what happened in the referendum, 80/20 Investor at least brightened my day. So there you go. You've got both sides of it. I mean, like you say, it's a bit sweet that you make money out of falling markets. But interestingly, I've almost forgot to mention it, because of what the 80/20 portfolio did, the Wall Street Journal got in touch with me and interviewed me over the phone about it. So that was because they heard about what happened. So there you go. That's another interesting bit. Anyway, that's enough about me. You can go onto the Money to the Masses website, read more about it, and take out a free trial if you wish. Lastly, how would a Brexit affect your pension? Anyone who's got a pension out there, if you've got a final salary scheme, you should be okay. I wouldn't worry about it. If you're drawing your pension, say via annuity, then your income should be impacted, as it will be protected under the Financial Services Compensation Scheme. If you are in what is known as pension drawdown, where you keep your pension invested but you can still draw an income from it, you may have issues, because depending on where you're invested, there's a trend for people to invest in the UK. What happened to me on 80/20 just proves that you've got to think globally. Despite at the moment most of the UK seeming to be very insular, you've got to be global about things. So if you've been investing in UK stuff, your pension fund has probably just dropped. Some of it, you may make some of those losses, but what it means, if you're encashing chunks of it to pay an income, then you're going to have to encash more than you did last month to pay your income, and therefore if that continues, your pension fund will run out. So it just highlights the idea that if you're going to build a pension fund to produce an income, especially a regular income, you're better off doing it using things like equity income funds if you don't want to buy shares directly. If you're going to buy equity income funds that pay out a regular income stream, and of course dividends are paid out based on so many pence per share. So the income you get, it doesn't really matter. Once you're in, the value of your portfolio can go up and down, but the amount of income in pounds and pence will be whatever is paid out. Do you see what I mean? It's not dependent on the value of your portfolio. So if it pays out a certain amount each month, it should keep doing that and it should grow, as long as the companies that are paying those dividends maintain it. So that becomes your only worry, not the fact about what your portfolio is doing. So if you want to know more about that, speak to a financial advisor, or you can always email me and I'll fill in the details. The ironic thing is there was a mass vote from the older generation about wanting to leave the European Union, and they've slightly shot themselves in the foot, because obviously a bunch of them have seen their pension funds fall and therefore their incomes potentially fall. But those who decide they're going to be safe and buy annuity, within days of the referendum, insurance companies, a number of them already cut their annuity rates, so they're going to get less income now going forwards than they were beforehand. So they might blame immigration or something if they want to, but actually ironically that's their own fault on that one. I think that's about sums it up, because I'm conscious we've probably gone on a bit longer than we normally do, but this is an important topic, so I think I'd need to wrap it up. But we had a couple of questions that people sent in. I think I broadly covered most of them. There was one I received about them due to retire next March, and how will their private and government pension be affected. I think largely speaking, I've kind of covered it. I don't think it'll be much impact. Look, we've got a lot more to unravel before then. I think that basic state pensions should be largely unaffected, and we're just going to have to see how things pan out. Your company pension, it shouldn't be an issue as well. So yeah, I wouldn't worry too much.
Good. Obviously, it's a special podcast this week. There was a lot to cover, so we have gone on a bit longer than usual. Hopefully it was useful to you, our loyal listeners, and I hope you got something out of it. Do, if you can, share the podcast, talk about the podcast, review the podcast. If you want to get in touch, you can. It's podcast@moneytothemasses.com. Damien's also on Twitter. It's @moneytothemasses with a number 2. Damien, we're done.
We're done, Andy, and I think at episode 93, I think it's the first time you've ever done that on the first take. So yes. I have to applaud you.
Good.
That is it, Andy. Until next week, let's hope the sun is shining and everything's a lot better.
See you later. Cheers.
See you later.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.